please go through this disclaimer. Welcome to the third part of the basic building block series. So in the first two parts, we had learned what are basing candles, what are momentum candles, that is rally candles and drop candles. Then in the second part of the series, we had learned these four basic building block patterns: the drop-based rally, the rally-based rally, the rally-based drop, and the drop-based drops. So in this particular video of the third part, we are going to learn how we shall mark the zones. That is the demand zones and the supply zones in these four cases. So let us start. So I'm going to share with you three basic ways to mark the zones depending upon how aggressive or how conservative you are in marking your zones. And there are certain exceptions also while marking zones. I'm going to talk about those as well. But let's start with the most simple ones. So the simple way of marking the zones is you take the basing candles within these and you find the highest high among the basing candles and the lowest low among the basing candles from wick to wick. So in this particular example, the highest high of the among basing candles is this, and the lowest low among the basing candle is this. So this is how you would mark the basing candles, right? There is an exception to this. I'll tell you about it in just a while. But for now, just for the first part, when you're learning how to mark zones, just focus on this simple way of marking zones. That is the highest high of the basing amongst the basing candles to the lowest low amongst the basing candles. So in this case, I would mark this in this way. For this one, I would mark this way. And for this one, I would mark this way. Right, so this is a demand zone. So what we expect is when price comes back to this basing area, penny contracts will be released on the buy side and price will move up. Similarly, again, this is the demand. So when price comes back to this, price again moves up. And this is supply. So when price comes back to this zone, we expect sell pending orders or sell orders to be released here and prices to drop. Similarly, we expect prices to drop when price returns to this basing area or this zone. Let me just delete them. Okay. So we have learned how to mark these zones. Now, there is a little exception which I'm about to share with you. In certain cases, so hope you have learned the basic way of marking the zones. And okay, before I go to the exceptions, let me also share with you the two other styles of conservative zone marking. So in the first part, you learn to mark wick to wick, top of the wick to the bottom of the wick, right? And the second way to mark the zone is a bit conservative. In that particular way, you look at the highest among the highest high of the bodies of the basing candles. So in this particular example, we have two kind of doji basing candles, and the highest body, upper body among these is this one, this price area, right? So this is body number one, body number two. Amongst the two upper bodies, this is the highest one. So this is a starting point, and the lower part would remain same as the first way of marking, that is the lowest low of the basing area in case of a demand zone. So we would mark it in this way: highest body along the basing candles to the lowest low of the wicks of the basing candles. Similarly, in the Rayleigh Valley case, again, the highest upper portion of the body among the basing candles, this one, and the lowest low of the wicks of the basing candles. On the supply side, let's just flip it. So the lowest body of the basing candles is this one. Among these two basing candles is this one. And the highest high of the wicks is this one. So the zone would be marked like this. Right? Similarly, again, the lowest low of the body and the highest wicks is just the mirror image of the ones that we drew in the demand zone cases, the supply ones. Right? The lowest body and the highest wick. So just pause the video if you want and just take a look at the differences, or you can rewind back to the previous case where we marked from wick to wicks. Now we have reduced our entry a bit in case of demand zones and supply zones. So instead of marking the zone from here to here, we are marking it from the highest body to the lowest wick. So we have reduced the size of the zone in this particular case. So this is for traders who are a bit conservative, who want to trade with smaller zones. So this is the second style of marking zones. Then the third style of marking zones is even more conservative. For the third style of marking zones, which I must say very few people follow this, because the problem with that third style of marking is that you might not get entries in most trades. But yes, it reduces your risk a lot if you are trading, let's say, futures, in which sometimes position sizing is not possible. In that case, the zone size becomes important to define your risk in that particular trade. So traders sometimes use this conservative way of marking. This is the ultra conservative way of marking zones, wherein you start your zone from the lowest body of the basing candles and till the lowest low of the basing candles. Right? So in these two particular cases, the lowest body position is this. In the previous case, we took the highest body and marked it from there, right? In this case, we are going even more conservative. We are going for the lowest low, like this. See how thin the zone is. Similarly, like this. Right? Oh, I'm sorry, this is a demand zone. So this is the lowest low. This is the lowest part of the body. Like this. Then this is supply zone, so the highest part of the body and the highest part of the wick. I hope you're getting the idea of how it is being done. Again, this is also supply zone. Similarly, the highest body. Right, so this is the third case. So let me change colors and mark all the three styles with different colors. So let's say the third way of marking is done with blue boxes, blue zones. Let me mark with the orange zone. The second conservative way, this would be the highest body. It's the second way of marking the zone. Right. And let me use black lines to mark the not the black lines. It would mix up with the candle color. So let me use this purple line. Okay. So this is the first way. This is the most aggressive style of marking directly from wick to wick with the bigger zone. This is the first way of marking from wick to wick. See the variation in the zone sizes. That's why the first one is the most aggressive. It has the widest zone. The second one has a smaller zone compared to the first one, and third one is even more conservative, smaller zone. So this is the three styles of marking, right? Now the exceptions. Let me just erase all these. Now the exceptions. So what are the exceptions? So the exceptions are especially in cases where we sometimes have to adjust uh, the lower portion of demand zones and the higher portion of supply zones. What I mean to say is that if amongst the basing candles, right, if the move-in candle or the move-out candle has their lowest low or the wicks being lower than the basing candles, then we have to factor in the lowest low amongst all these candles. So in this particular case, please listen carefully. I'm sure some of you might be a bit confused, or maybe it's going really fast for you. So in that case, you have to rewind the video and watch it a couple of more times. But you would get it really, because I'm sharing everything regarding zone marking in this particular video. It's just that maybe I'm putting in a lot of information in a very small time. So just rewind the video and watch it again, or rewatch the video after some time again, or make notes. Okay. So what I'm trying to explain is that in certain exceptional cases, the lowest low in a drop-based rally case would not be just the basing candle's low, right? In this particular case, you can see that this move-in candle, this red candle's low, is even lower than this low. So in these exceptional cases, we would take this as the lowest low, the low of this candle. The high remains the same if you mark with the first style, and the high remains same over from here if we use the second style, and the high remains the same from here till here if we use the third style, right? So I'm marking zone only basis the first style, okay? So that is how I do it most of the time. So this is the highest high, and the lowest low is an exceptional case. This is the lowest low. So zone would be something like this. Because this is the exception case where the lowest low of the moving candle is lower than the lowest low of the basing candles. So this would be our zone, right? In this case, nothing is required. This would still remain the same, right? This is a normal case, but exception would have been if, let's say, the leg out candle's low was lower than the basing candle's low, like this, right? See this? It's lower than this. In that case, the exception rule kicks in, and we would better mark the zone like this. From the upper portion, remains the same. The lower portion gets changed of the zone, factoring this lowest low, right? Like this. This would be the correct way, because it again becomes an exception. In this case again, you can see that this is also an exception case. The high was higher than the basing areas over here. So we would take this one. The lowest low would remain this one. So this is the supply zone. This is the way we would mark it. From here to here, not from here to here. And this is also fine. There's no change in this. Right? This is how we mark supply zone. But this is a non-exceptional case. Exceptional case would have been if the wick of this candle would have been above this, like this, above this height. So in that case, we would mark the zone factoring in this highest point. This would remain same, the lower portion. So this would be the correct supply zone. So just rewind the video if you are a bit confused or if you want to take notes. Zone marking is important. As you gain experience, of course, you will figure out your own style of zone marking. So this is how the zones are marked. And once you have marked the zones, so let me teach you how to mark the entry lines and the stop loss lines. Because target, I'm not marking, because target would depend upon whether you are doing trades basis risk reward. If you're doing trades basis risk reward, then obviously the target would be like 2 to 1 or 3 to 1 size of the zones. Or if you're using an opposing zone based targeting, see, targeting is a bit, it's an important topic as such, the whole topic in itself. So it better I cover it in a separate video, right? So that's why in this particular video, I'm just explaining how to mark the entry and the stop loss lines once you have marked the zones correctly. So for this particular case, once you have marked the zone like this, entry line would be the upper part of the zone. This is where we would take entry. Let me draw a trickle line if it's not visible. Like this. Okay, it's super thick now. Anyway, so this is how you would mark it, the entry line. Mark it with blue. No, purple is fine. Yep, and the stop loss line would always be slightly away from the zone. The lower portion of the zone in case of demand zones like this. Because we do give some areas of prices to sometimes, little bit of peaking out and little bit of room for prices to move. If you keep it very tight, sometimes the pending orders are just right close towards the end of the zone. They might just fake out a bit and then move out. In this particular demand zone, again, the stop loss would be at the slightly below the zone. And entry would be again the upper portion of the zone that you've already marked. And similarly, in this case, the supply zone, the entry would again be here. And stop loss would be slightly above this. Entry again would be in the supply zone over here at the start of this zone. And stop loss will be slightly away from the end of the zone in case of a supply zone. So in case of demand zones, the stop loss is below the zone, and in case of supply zones, it is above the zone, which is logical because in case of demand zones, we are looking for price to give an entry and then move out. So only if the zone fails that we should take our stop losses, so therefore stop loss should be below it. Similarly, again, in this case, it's also a demand zone, so prices enter, then moves up. This is an expectation out of this demand zone. So stop loss below it if the zone fails. And this is a supply zone, so prices will come here and then fall from here. That is the expectation. If the zone fails, the stop loss is above the supply zone. Similarly, here it's a supply zone as well. Similarly, we expect a fall from here, and therefore the stop loss line is just above this supply zone, drop based drop, just in case the zone fails. So this is how we mark the zones, and this is how we mark the entry and stop loss lines. Targets could be in a separate video. I'll explain what they could be. They could be at least two times of their zone size, somewhere around here for this particular case. So these are basically risk-based targets. So if you lose in this particular demand zone, you're losing this much, right? You're basically losing this much from here to here. This distance is your stop loss, or the loss that you would make if this demand zone fails and you were long at this demand zone, right? So target should be, if it's a risk-based ones, I'll have it in a separate video, should be at least 2 times this particular zone. Let's say this is 2 times the zone, right? So you would have your target lines over here. Assuming that this distance is twice the distance of this stop loss to the entry. So if this is your R, if this distance is R, so this distance should be twice R, 2 times R, right? This distance. So then you have a setup with entry here, stop loss here, target here, and the risk reward becomes for this trade 1 by 2, or reward to becomes 2 to 1. So if you lose, let's say 10 rupees here, you're making 20 rupees if you win in this trade. So I'll take it separately because targets are quite important topic, and there are different ways to get targets. Some use time frame analysis, some use this risk-based targeting, some used opposing zone in the same time frame as targets, and there are different ways, and it's an advanced topic, so, and an important one. So I'll cover it separately in another video. But just give you a very brief method of targeting, basis risk rewards. So as usual, let's go back to the live charts. There's no fun in learning without live charts, right? So let's see. Let's spot zones and mark them. The first zone I spot over here is this drop-based rally. So let me mark this. This is a drop-based rally. It's a demand zone because the move out is the rally candle. So here, this is the aggressive style of marking from wick to wick. The basing candle's highest wick you can see over here is this one. The lowest one is here. And look today how beautifully this zone played out. Prices dropped here, went in, sprang up, formed this hammer for the candlestick buddies, and then it went up. So this was a super strong demand zone with a lot of pending orders or buy orders unleashed by institutions from this particular demand zone. This is a nice drop-based rally demand zone. Then we have another one on the way up. This is the rally, 3 candle base and a rally. So the highest high among this is this one. The lowest low among this basing candles is this one. See how price went back into this zone and then moved up, another rally, right? So this also worked so beautifully nicely. Then we had another drop base rally. So this stock was on a roll that day. Again, prices went up, went in over here, and then again shot up from the demand zone, right? So institutions were, continuously creating these demand zones, respecting them, moving up from those. And so this is demand zones, drop-based rally and rally-based rally, in the way I marked it using the first style of marking. Now, if I mark them based on the second style of marking, that is, in the first case, since there's only one basing candle, so the highest body to the lowest low of the wicks. So this is how I would mark, right? Observe carefully, this is the second style of marking, right? So in the first style of marking, you would have gotten entry. The second style of marking, you would have gotten entry, right? But the third style of marking would have been like this, right? From the, if it is broaden this chart a bit, you can see from the lowest low to the lowest part of the body of the basing candles to the lowest low. So in this case, I would have missed the entry. So price went in till here and then moved up. So that's why I said that this is a very conservative way of marking. And it is normally used in cases when the wicks, when the wick of the basing area is pretty large. I'll explain that in another video. So for now, let's just stick to simplicity of definition. So this is the third style of marking, and this is how we would have marked it. In case of rally-based rally, again, The second way of marking would have been pretty same because the highest body among these candle is this itself. So this would be this, the first and the second style would be the same in this particular example. And in case of the conservative style, it would have been the lowest of the bodies of the base candles and the lowest low, right? So you may ask, what is the benefit of marking the third style of zone marking, right? This ultra conservative. So one point I would like to show you over here itself is that you see in this particular case where the third style of marking made this zone so tiny that if you are doing a risk-based targeting, if let's say price just went in deep into the zone over here, touched this the third style entry, and then moved even up till here, right, which is just above the basing area. This in itself is more than 2 to 1 risk reward because your risk is reduced so much that even coming till here, just slightly above the whole basing area itself, gave you a more than 2 RR here. So you would have actually exited if you were a third style of zone marker, then you would have already exited with a 2 to 1 or a, 2.5 RR, whichever your whatever your trade plan suggests, whatever you choose to be in terms of targeting. So this would have given you an exit very quickly. Whereas had you been the first type, just ignore this entry over here. Let's say this is fresh zone and prices just entered over here. It went up till here only, right? So till here, not even a 1 RR in this style of marking, and then it broke, it went down. So you would have got stopped out here if you had stop losses over here, right? But had you practiced the third style of marking, this little bit of movement till here was sufficient to give you a more than 2 RR. So you would get this with experiences, why zones are marked. But personally, I don't prefer this style of marking unless until the wick is very large, like in this case. In this case, if I consider this is not a good demand zone, but even if I take this as a demand zone, as a rally, a base, and as a zone. So the third style of marking would be this, right? And in big basing candle cases, the third style is useful. Otherwise, I go for the first style or the second style. And with experience, you would get your own style. This is my suggestion to you. So different traders bases their own psychologies. Some people hate to miss trades. So for them, the wick to wick, the first style is useful. Some people are more conservative. They are more focused on reducing their risk. So for them, the second style or third style is more suitable. So you need to figure out which style is best for you. I've shown you all the 3 styles. And sometimes you can devise your own style. It doesn't have to be in a very strict fashion. So trading is as much as an art as it is a science. So let us look at some more examples. Let us look at supply zones. So in this particular example, we can see the drop, 1, 2, 3, 4 basing candles, and then a sharp drop. So the highest among this is this part. The lowest low is this one. So I mark from here to here, the first style of zone marking. So this is a supply zone over here. A drop, base, 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 drop. Price entered here. It give you a drop right till here, and then it went up. So in this video, we're not discussing about the quality of zones. Quality of zones matter a lot. Not all. Okay, let me give you this particular important information. These are only building blocks, right? Not all of these patterns which appear in the chart are tradable. They're not high probability setups themselves. For understanding which zones to trade and which not to trade, it'll come through experience, come through more learning. There are different factors that are needed to qualify a zone as a tradable zone versus a non-tradable zone. So you must not jump into a trade the moment you've learned this video and you spot these patterns in the charts. Not all zones are tradable, right? You can see in this chart itself. See, this was not a good quality zone. It just, I mean, for me, this gave a 1-to-1 RR if I mark this wick to wick, and then it broke this. So this was not one of those important zones anyway, right? And on the other hand, this particular zone was really a good one. Not because it gave this kind of huge bounce or huge RR, but there are certain advanced concepts which you will also learn, because of which I would have combined these two zones together. These are called stack levels, which is coming in the next few videos. So I would have marked these two together and I would have created this one, right? So for now, we'll learn about stack levels, or level just adjacent or touching each other like this. They're called stack levels. I'll talk about them and how to deal with them in this beginner series itself, but in the next few videos, right? So this is the supply zone. This one we have marked drop base drop. Let's see. Okay, this is a rally base drop. Again, a single basing candle area. So this is how you would mark this. See, not all zones that you spot in the chart are tradable, right? So this is a lot of basing candles here, right? So this is from wick to wick, huge zone. This is how you would mark the supply zone from wick to wick. From base to wick, the highest, so the second one, the second style, the lowest body, this is the second style of marking. Third style is this one. I mean, in this case for supply, the highest body position. From there it starts and then it ends to the highest wick. Okay, this is supply zone I've marked. So that's it in this video. I'm sure there's a lot of information shared, especially for new traders who are new into this style of trading. I request you to watch this video at least twice or even thrice if required. And please take notes of the important points. It's been a long video, but I'm sure you will find important valuable pieces in each minute in this video. So go ahead and rewind and keep on practicing. I would say go to your own charts, open up your own price charts, and then start marking these zones on your charts, right? And see what happened to those zones. And although it won't be much useful at this moment of time because you're just in the building blocks right now. I mean, you haven't learned enough if you just watch these three videos to start trading. I would recommend that you do not trade at all by watching just these three videos. So there's more to come because there's a lot of information to share in terms of the quality of zones. So next we'll talk about the quality of zones and other important things in this basic building block series. So stay tuned and happy learning to all of you. And if you have liked this video, then please subscribe to this channel. It really encourages me if you subscribe and stay on with me in this journey of learning. So all the best. Thank you for watching.